Hello guys, in the following minutes I want to discuss the basic of position trading, the advantages of adopting this trading style, and we will also see 3 position trading strategies you could implement right away. Position trading is a trading technique which looks at the bigger picture of the market, usually involving a combination of technical analysis and fundamental analysis. When evaluating the markets, position traders usually make their research on weekly and monthly price charts. I'm sure you already know that 90% of traders lose their money and maybe only 5% of them make any real money from trading. This is due to the fact that the majority of traders enter the market with a get-rich-quick mentality. Short-term trading can be profitable, but on the long run, you'll be safer when adopting a position trading attitude. When executed correctly, position trading comes with several advantages. The most important advantage of the position trading is the fact that it eliminates market noise. Sometimes when trading on short-term time frames, you get caught up in the market price fluctuations, rumors, or constant monitoring of the market. That is market noise. Position trading on higher time frames will help you to remove the market noise and to extract the correct information from the price. Another advantage is the flexibility. While day traders monitor the price action very closely and their screen time is considerably higher, position traders don't have to deal with such problems. Position trading is more flexible as it offers time away from the charts. Also, position traders execute fewer trades and they don't have to monitor the trades all the time. Another advantage of the position trading is the fact that you don't overtrade. Position trading keeps you away from the daily temptations of entering and exiting the market many times throughout the day. Position traders do not trade actively and execute fewer trades. Also, position traders don't have to deal with the daily stress arising from trading. That's because their positions have plenty of room to survive to the market volatility. Another important advantage of position trading is the fact that signals are more relevant on higher time frames. Position traders often use the daily, weekly, and monthly charts. They are not interested in analyzing lower time frames. This adds weight to their trading systems. For example, a divergence is more stronger on the weekly chart than on a 15-minute chart. A moving average crossover has more relevance on a daily chart than on a 5-minute chart. By using higher time frames, position traders improve the quality of their signals. Now that we discussed the advantages of position trading, let's see a couple of strategies used by position traders. An efficient position trading strategy is divergence trading on a weekly and monthly charts. Divergences are more reliable on higher time frames because the market does not move as fast and is easier to define trends. By trading divergences, the position traders see the patterns developing and have time to make the correct decisions. In this weekly gold chart, we spotted an excellent hidden divergence opportunity. The price recorded a strong upward trend and then retraced to the 23.6 Fibonacci retracement level. During this time, a hidden divergence pattern developed on the stochastic oscillator. This represented the perfect buy opportunity for a position trader, the gold price continuing its upward trend. A similar pattern is seen in the Aussie dollar weekly chart. After 4 months of price increases, the market retraced to the 38.2 Fibonacci retracement level. The stochastic indicator showed a hidden divergence around that area, representing a good opportunity to buy for a position trader. The price indeed rejected that area and continued its upward trend for the rest of the year. On the Apple stock chart, we found this pattern once again. The Apple price was in a strong upward trend on the weekly chart. The price retraced to the 38.2 Fibonacci level. This move, combined with a hidden divergence on the stochastic oscillator, represented a great opportunity for a position trader. As you can observe from these examples, The hidden divergences represent a reliable tool for position traders on a higher time frames, generating high probability signals. Another viable strategy for a position trader is the carry trade. The carry trade is an interesting Forex long-term strategy that is based on the difference in interest rates around the world. It's a strategy through which a position trader sells a certain currency with a low interest rate and uses the funds to buy another currency that generates a higher interest rate. By executing a carry trade, the position trader intends to generate profit from the difference in interest rates between the two countries. Also, with an appropriate approach, the position trader aims to benefit not only from the difference in interest rates, but also from the changes in the exchange rate. Here's an example: the Aussie dollar and the Japanese yen on the monthly time frame. That's a good opportunity for a carry trade because there is a big difference between the interest rates of the two countries, so we could make a profit in the long term from the swap. We determined the main monthly relevant support and resistance and potential price patterns, and we identified the possible long position in the direction of the prevailing upward trend after the price rejected the 38.2 Fibonacci level. A long entry on the currency pair would be a safe entry considering the long term. The long position on the instrument is related to a positive swap, and the profit of such transaction would be even greater if the currency pair would continue to move upwards. Another position trading strategy involves moving averages. The moving averages are probably the most well-known and heavily used indicators in technical analysis because they effectively capture the trend of a financial market in an easily identifiable manner. Position traders often use moving averages for identifying and confirming support and resistance levels. A crossover between two moving averages is probably one of the most well-known technical analysis signals used by traders. This strategy is simple, as position traders trade moving averages, one with a shorter period and the other with a longer period, and track the signals when the crossover occur. This is the simplest position trading strategy because moving average crossovers on higher time frames work better than crossovers on short-term charts. This is likely because they produce fewer false signals. However, be careful with moving average crossovers because this strategy works only in trending markets. When the market is in a range, you'll probably see something similar on your charts. Despite the fact that position trading is a long-term strategy and takes some time to profit from the market, it's a safer alternative compared to the other strategies in the market. Use it in conjunction with a long-term trend, and with a proper money management system, the position trading might bring back the enjoyment of trading without having to spend all day in front of the computer. If you got any value from this, please consider subscribing to our channel, share and like this video, as it would help us a lot in the future. Until next time.